Hi, are you a corporate executive working in the non-finance domain? And do you have to factor in accrual as a concept in your decision making? If the answer is yes, then this is the right video for you. Welcome to our part 2 in the video series. I'm Saujanya and I coach corporate executives and business owners to understand finance in the most practical way. In one of our training programs in finance for non-finance domain, we were using an example to explain accrual in the most practical way. Since the participants were from the non-finance domain, it was important for them to understand accrual in the most practical way. Getting inspired by that, we have created this video series. And in this series, we are in part 2. In part 1, we have spoken about expenses, outstanding expenses and prepaid expenses. In the part 2, we're going to be talking on income. But before we do that, let us take you through the basics. At least this is going to benefit for those who have not seen the part 1 series. As a concept, accrual, what does it mean? Accrual means transactions which are recorded irrespective of the actual cash payouts or cash receipts. There's no transaction in money. But of course, accrual as a concept is an important concept. So what does it relate to? It relates to both revenue as well as expenses. The most clear and a brief definition we would want to bring in to help all of viewers is, if we are talking of accrual of revenue, then the right to receive the income is established in the favor of the entity or the business. And if we are explaining accrual with the perspective of the expenses, then the business entity has already had the obligation to pay for the expenses because they've utilized the services for which they have to pay. This is the most clear or a short, brief definition which we can give you for accrual of expenses and income. Coming to the topic of today's video, which is about income, let's take you through the outstanding income. As the name suggests, outstanding means the entity is yet to receive the income. So what is the implication in the journal entry format? Outstanding income is something which has to be recognized in the profit and loss account as yet to be received. Since it's not an obligation but a right to receive the income, it is taken into account when the actual receipt happens. So bank account debit to the outstanding income. So we were talking outstanding income, so it's going to be added in the profit loss account along with the interest income or the income categories, and it's going to be understood to be received when it's actually received. This outstanding income is an asset in the balance sheet, which we're going to be discussing after we discuss about income received in advance. So the next one would be income received in advance. If the entity has already received an income for which the business of the entity is yet to provide goods or services to their customers, then this should be understood as a liability till such services are provided to the customers. So the accounting implication is the entity would first receive the income. So the bank balance is impacted. So bank account debit to income received in advance. Such an income received in advance would be adjusted to the income once the goods or services are rendered. Till that time, as we can see, it is to income received in advance, so it's a liability. To also take a quick recap of the presentation of accrual of income, especially the outstanding income, is factored in the profit and loss account. Profit and loss account is something which is drawn up for a period of time. For example, profit and loss account or income statement is for a year ended, a quarter ended, month ended. Let's say we take about a profit and loss account which is a year ended. This profit and loss account is drawn up for a period of 12 months. And if we have a category of income which is supposed to be understood to be earned over a period of time, where the metrics for measuring the income earned is time, and it is monthly to be recognized as earnings, since such an income has to have a 12-month time frame into consideration. So an income relating to 12 months has to be shown under the profit and loss account. If for whatever reasons the 12 months income is not shown, only 9 months income is shown, then the balance 3 months of income has to be recognized as an outstanding income. For whatever reasons, if the income is already received earlier before the reporting date, then till the date of the reporting, whatever income is supposed to be understood to be recognized, say for 12 months, has to be seen. For example, if the entity has already received 15 months of income or 16 months of income, the 3 months or the 4 months is an excess income which is supposed to be recognized as an income for the next accounting period. Such kind of a income received in advance is not considered in the profit and loss account. If it was already considered, then that has to be removed. Such an income received in advance is always a liability till the income connected to the goods or services, or the goods and services is service provided to the client, and the outstanding income would be an asset. I hope you've liked this concept. To help you to take a quick recap, we were discussing the concept of accrual in two-part series, Part 1 and Part 2. Part 1, we're going to be talking on the example what we have used in Finance for Non-Finance training program, where we were talking about the concept of accrual to the executives in the non-finance domain, and they had to understand accrual concept in the most practical way to factor in that decision making. We can take an example of outstanding expenses in Part 1. In today's video, let's take a recap of the example what we have used for Part 2. An outstanding income is something where the entity has got the right to receive the income, and this right would be considered shown in the profit and loss account as a receivable income. This is also shown as an asset in the balance sheet. When we come to income received in advance, the entity would have already received the income, so there is a cash inflow, but the income to which the entity is received it is yet to be serviced to the client in terms of provision of goods and services. So till the entity provides the goods and services, such an income should be understood as a liability and parked on the liability side. Once the goods and services are provided to the customers, this income received in advance is adjusted to the actual income. I hope this snapshot of the concept and this explanation where we have picked up from a practical training session is useful to you. If it is useful to you, please do like and comment about how you felt, and please do share it with others who can get benefited. You can also join our community called C.A.F.E, where the link is open for both Telegram users as well as WhatsApp users. We would have more such interactions on a daily basis, and please use this community to upskill yourself. See you in our next video.